If you want to invest in mutual funds, you have the desire to invest in mutual fund. So how will you go about it? And this video actually is for you how to choose the right mutual fund for your investment goals. So first of all, I want to talk about the definition of your investment goal. That will determine the kind of mutual fund you would invest in. So when it comes to the definition of your investment goals, you consider growth. Consider growth. So if your primary goal is to grow, you want to grow wealth over time, you may want to choose mutual fund that focus on stocks, such as equity or growth funds. You may invest in equity funds. You may also need to invest in growth funds. These funds are aimed for they aim towards capital appreciation by investing in companies with strong growth potentials. Their ultimate goal is to grow your capital, and so they invest in equities that have that potential for outsized growth. You also consider income. So if you are looking for regular income from your investments, so bond funds or dividend-focused equity funds may be the right choice for you. These funds invest in bonds. Not only that, they invest in dividend-paying stocks to generate steady incomes. They invest in bonds as well as dividend-paying stocks so as to be able to generate a steady income for the investor. You may also consider a balanced fund. So for those seeking to actually have a mixture of both growth and income, a balanced or target date funds may be ideal for them. These funds combine stocks and bonds to provide both capital appreciation and income, adjusting asset allocation based on target dates or a specific risk profile. They adjust their portfolio to suit to mitigate risk and also obtain the desired income they want to obtain. Number 3 is consider your risk tolerance. After defining your goals, you consider your risk tolerance. So in this case, we want to look at high risk tolerance. So if you are comfortable with volatility and are willing to accept higher risk for the potential or greater returns, so in this case, equity funds, small cap funds or sector-specific funds may be a good fit for you. If you have moderate risk tolerance, you may go for a balanced fund. You can also consider mid-cap funds or balanced funds that mixes both stocks and bonds. Then if you are the type that have low risk tolerance, if you have low risk tolerance, if you prefer more stability and concern about fluctuation in value, you consider bond funds, money market funds, or conservative allocation funds. These funds are there for those people with who cannot stomach much risk. Number 3 is time horizon. Is it long time horizon or is it short time horizon? We just considered the risk tolerance. We want to look at time horizon. These are factors that determine the kind of investment you go into or the kind of strategy you adopt. So if your investment is for a long-term goal, such as retirement or child education, you may have the flexibility to ride out market volatility. So in this case, equity funds, growth funds, or index funds could be suitable for you. So in addition, if you have a short-term horizon, if your goal is to use the money in a short time frame, example within a few years, you may consider funds with lower risk and more stable returns, such as bond funds or money market funds. Number four is understanding, fund types. Understanding fund types or types of funds. You have equity fund, you have bond fund, you have balance fund, index funds, as well as sector specific funds and target date funds. So these are the types of funds that you could consider. Equity funds deals with equity, bond funds invest in bonds, balance funds include equity bonds and other asset classes, while index funds are there to mimic the performance of the market or the overall index. You may consider anyone that is suitable for you based on your investment objectives. Number five is examine fund fees and expenses. These mutual funds, they carry fees and they equally have expenses. So you consider this because eventually it may eat into your overall return. So under these fees, you have expense ratio. The expense ratio is the annual fee charged by the fund to manage the portfolio. Lower fee generally result in higher returns for investors. Index funds tend to have the lowest expense ratio, while actively managed funds have a higher fee due to research and management cost. You may also look at sales load. Sales load here. Some mutual funds charge a load, what is called sales load or commission when you buy or sell shares. So you look for no load funds, to avoid these extra costs. There are funds out there that don't charge any fee. So they are called no load funds. So you will need to take into consideration transaction fees. Ensure you understand any additional costs involved in buying, selling, or transferring fund shares. So look critically at their fee structure to know precisely what to expect. Please like this video and subscribe to this channel if you've not done that. Number six is review the fund's performance history. Review the fund's performance history. So in this case, you consider historical performance. It may not be indicative of future performance, but it's worth looking into. It's worth considering. So while past performance doesn't guarantee future results, reviewing a fund's historical returns can provide insight into how it has performed, under various market conditions. Compare the fund's performance to its benchmark index to assess how well it has achieved its objective. Compare the performance of the fund with whichever benchmark the fund is tracking, and then you look at you look at the differences. So you also consider risk-adjusted returns. Risk-adjusted returns. So evaluate how the fund has performed relative to its risk. Funds that generate good returns with less volatility may be more appealing for conservative investors. It's not just making returns, but at what risk? That risk will determine whether you will invest in the fund or not. So you consider the risk-adjusted returns. Number 7 is check the fund manager's track record. Check the fund manager's track record. Okay. So in this case, you consider fund management. The experience and track record of the fund manager, are key factors in selecting mutual funds. So experienced manager may have a better ability to navigate market changes and generate returns compared to a new inexperienced manager. So you also look at management style. Understand whether the manager uses a value-based or growth-based investment strategy and ensure it aligns with your own goals. Number 8 is consider tax implication. In this case, you may use taxable accounts. You may also look at tax efficient funds. Some funds focus on minimizing taxable deductions or distributions, such as tax managed funds or municipal bond funds, which may be beneficial if you are in the higher tax bracket. So you also consider taxable account. If investing in a taxable account, consider the tax implication of mutual fund distributions. So bond funds and equity funds that pay dividends may result in higher taxable income. Then number 9, evaluate fund liquidity. How easy it is to sell or to buy the fund concerned. So mutual funds can be bought or sold at the end of each trading day. So the net asset value price is what you buy at or what you sell at. However, some funds may have restriction on the frequency of transaction or impose penalties for early withdrawals. Consider the liquidity of the fund if you anticipate needing access to your investment in the short term. You ask yourself how liquid is the fund. In case you need emergency fund, you need emergency money to take care of, responsibilities around. So how liquid is the fund? It's necessary you consider this.